Welcome to Commodities in Transition, a new series by Westpac Economics looking at the macroeconomic drivers of commodity markets. Joining me today to discuss these key issues is Justin Smirk, one of our senior economists who's also our expert on commodities and also inflation. Justin, welcome.
Thank you very much, Elliot. It's good to be here.
Great to be here. Now, it's December. Obviously, it's time of year to think about what the new year might bring. We've had a year of uncertainty, and that has played through in commodity markets. How do you think they're placed at the moment, thinking about how they'll move into the new year?
Because you started off with a very interesting point about how the next 12 months is going to evolve. The last 12 months have seen commodities being pushed and pulled in many directions. We've seen some commodities being hit by both surging demand, particularly we've seen with coal, with the collapse of the Russian supply of energy into Europe, matched against tight supply conditions, both weather conditions here in Australia, and we have to acknowledge we're now seeing an extended period of underinvestment into carbon-based energy in many parts of the world. So you've got these commodities that are being pushed up by that environment. At the same time, you've got other commodities that are being hit by fears of growth. You know, what we're seeing of the recession building in Europe and the fears of a recession in the US. That's all building, putting sort of downward demand pressure on particularly things like, for a while there with base metals, and even helping to hold back energy prices for things like oil. So then you're trying to think about what's going to happen in the next couple of years, and particularly heading into next year, and you've got this, again, a reversing tension. You can see the rebalancing happening with commodities like coal, where we see a bit more supply coming online with these high prices, and you can see demand being suppressed by these high prices, meaning looking for massive investment in alternative energy sources. And again, also that recovery we're seeing coming through the developing world as well, adding to demand through 23. And at the same time, we see the fading fears of what's going on around a recession, and also starting to look forward towards whether the US Federal Reserve will cut rates and see some stimulatory policy. So put it all together, you've got some commodities, particularly like coal, that are going to be under some pretty meaningful downward pressure from extremely high levels. So coal's now trading at $430 a tonne. Normally, that's for thermal coal. Normally it's around 70 to 100. And you've got other commodities, like particularly recovery in, say, oil, in the recovery in demand. At the same time, tight supply conditions, because there's an underinvestment in that sector. Tight demand, very strong recovery demand for base metals in a normal recovery, overlaid with the sort of green revolution. And you've got an environment where you can have a very constructive overall environment for commodities as we're moving through 23, even though a couple of big key ones may be under downward pressure because of unique supply and demand conditions.
That's really interesting. So you touched on it already there a little bit. We've obviously, we're quite, cautious in terms of developed world demand, particularly US and Europe, given all the pressures they've been under this year. But we are quite constructive on developing markets, particularly Asia and China, going into the new year. How do you think that's most likely to sort of come through in terms of our key commodities that we export from Australia?
So that's a really interesting point, and it sort of gives us a sort of some pause to be like, particularly for our energy commodities, to be too cautious about becoming too bearish. I mean, there's a lot of sort of negative news out there about what's happening with coal demand in the sort of more medium and longer term. But you talk about a strong recovery and growth in the developing world, and that straight away feeds into the idea that they're going to need a lot more LNG, a lot more coal, and a lot more of sort of other sort of base materials to help build. Now, while you can build a big structure around of saying, well, we know we've seen China's peak steel, we know the recovery coming through in China is going to be not as intensively steel demanding as it has been in the past. You've got the rest of the world that's doing through a much more constructive growth phase. And that still really matters in terms of thinking about the overall big picture. So you put it all together and you've got resource producers being quite conservative about their investment profiles. You've got an outlooking positive demand profile. And to my mind, it suggests, just like we saw this year with sort of surprises coming around coal and oil prices and LNG prices, this kind of demand recovery in an environment where there's really restricted investment could produce some pretty meaningful upside surprises on some of our key exports.
Right, okay. So one of the areas we've been thinking a lot more about, obviously, and I think most of the world has been, is really the global green transition. And one of the sort of key things we've been talking about recently has been kind of the revolution we're starting to see in China's power generation capacity. Just, I guess, a simple point, their use of coal for power generation looks like it's peaking. And if we look at sort of Bloomberg forecasts, that's expected to really sort of decline quite materially through the back end of this decade and then all the way to 2050, as they use a lot more renewables. So what do you think are the kind of implications of a country like China, or potentially even thinking about more broadly across developing Asia, of undertaking this transition?
It's going to produce some really interesting tensions, and again, we need to think about China in a sort of and to not be too surprised, in a holistic sense. In a holistic sense, I mean China's also a massive coal producer. You know, they're self-sufficient in coal pretty much. So that then brings up this interesting idea of, so what does it mean if China's going through this period of declining demand for coal? In the first instance, you'd say, well, they're going to become an exporter because they've got too much coal. But then we also know their industry is old. It's a lot of mines that are very dangerous, polluting, inefficient and loss-making. So we know they've got a lot of those Chinese coal mines, as the industry is restructuring, will be closed as well. The question mark and the tension is going to appear is the unknown bit, is how those two match. So even though you can sort of look at the big picture of China and say, in balance, they may actually be quite neutral for the demand, it also has the potential to actually produce an excess of coal and actually become a major exporter. So this is where the interesting tension becomes, because normally you would expect in this environment coal prices to remain relatively well supported. But the fact that China's making such a rapid transition in its energy market, that if it's not reshaping its coal industry at the same time, at the same place, it potentially could become a large exporter, and the price of coal, even though we can talk about rising demand in places like India and through Southeast Asia and the developing world, that extra rebalancing, you know, given the fact that Australia is a major coal exporter and normally they fill the holes, could be the bit that tips the market over and results in a very big, large crash and drive prices back below $70 a tonne. And that's not the core view, that's not what we think is the most likely outcome, but so many uncertain things have happened in the commodity marketplace in the last couple of years, I'd be very hesitant to say it had a low probability.
Okay. So this is a bit of a bigger question. It's one we could probably spend a number of videos on next year. But thinking about kind of what we sort of said there about coal, and obviously Australia is quite a major coal exporter. Do you think China's power revolution and kind of the broader green transition, is that really, I guess, best thought about as being an opportunity or a risk for Australia?
I think it's an opportunity in the sense that we've already started moving down the path of making transitions ourselves. The level of investment going into carbon-based energy in this country, in terms of both domestic and export production, is flatlined, if not declining. So ourselves, we're already adjusting ourselves, which is a really good thing. By doing that, we're also helping sustain prices because we're a major supplier. So that keeps the industry perhaps going for longer than we anticipated. But more importantly, it's now opening up for other opportunities. We are talking about an environment where, at the same time as we're getting a recovery in global growth in a more organic sense, which is going to produce greater demand for commodities overall, you also have a refocusing. And we're talking about a major scale investment into large infrastructure projects to produce alternative types of energy. So not only, people often talk about the demand for copper and how strong it is, produce electric cars and electric goods, demand for nickel, for such things like batteries. It also means demand for steel to build infrastructure. We're actually looking at an environment where we may have, while it may not be like the emergence of 1 billion people in China, a new, more positive demand cycle, the investment cycle, that's more broad-based around the world, that can support a lot of our commodity base. So we're not just talking about expanding lithium and expanding copper, but also perhaps giving some longevity to our heavy exports, including iron ore, and metallurgical coal. And even while we're in this transition period, that additional demand that's been needed to help keeps our LNG prices more elevated than they otherwise would be. So it's a little short-term opportunity for our traditional stuff, a more longer-term opportunity for the growing commodities. But in the middle there is this double nexus of greening and economic recovery that's going to produce quite a nice little upward risk for a broad bunch of our commodity and resource materials.
It's a very interesting point to end on, and I think it gives us a good reason to come back in the new year and have many more conversations about all of this.
We can dive into this a lot more deeper there, Elliot. There's lots of little bits we can get really into and it'd be quite interesting. So,
thank you very much for your time today, Justin. And I'd just like to thank all our viewers out there. Really encourage you to come back with us in 2023 and investigate more of these issues and the implications for Australia. We'll see you next time.